Today, from the property market front line, Hero Brokers. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Today I'm joined by Clint from Hero Brokers. Hello, Clint.
G'day, Martin. Thanks for having us on.
Yeah, good to catch up. We've been exchanging a few messages over the last few days, and I know you are there right in the middle of all the things that are going on at the moment in the property and mortgage broking sector. So I think it's a good time to have a conversation, bearing in mind that there's some quite contradictory information out there. So maybe just to give a bit of a pen picture of yourself and Hero Brokers, and then we'll go from there.
Okay, nice. So I'm the founder of Hero Broker. We're basically an online mortgage lending company, or mortgage broker, similar to Uno or Lendi, and we're up there, one of the fastest growing online mortgage sites in Australia. So it's we get a real good feel of what's actually happening out in the market. We feel it's funny sometimes when you hear what's happening in the media and it might not be what we're feeling, or we kind of get a sense of something else. And yeah, it's kind of just following along some of your stats and then what you hear in the media. Pretty much, I get a good sense for the amount of deals that are coming through. What those deals are like, how resistant someone might be to purchasing a house. So I kind of get a good sense of what's happening in the market, and it's always good to back it up with some data, Martin. That's why I like to come to your site and see some of your information, and it's interesting. So
well, that's good.
Yeah.
And there's plenty of data from DFA, right? That's what we specialize in. So just to be clear, then, are you able to talk, with a national perspective, or do you have a particular geographic centre of gravity?
We do with loans basically all over Australia. So anywhere from I can't think of a state or territory or major city that we haven't dealt with in finance. So We get a good feel of what's happening. Yeah.
Okay. All right then. Well, let's go through the various parameters around the market. I guess the first question is deal flow, right? Because effectively the official story is that compared with, say, 6 months ago before the election, there are many, many more applications coming in to the hopper at the top. Are you seeing that?
I'm seeing it. There was definitely a spike after the election. So before the election happened, everyone knows that things slow up a bit before elections, and they seem to people seem to hold off. And what's funny is you feel people holding off even for refinancing, which doesn't actually make a lot of sense. You should refinance. What's the election got to do with refinancing? But yeah, before the last election, it really everything stopped, and it was definitely a unique election in that regard, that there was a big build up to it. And then definitely after the election, there was a big spike. But I wouldn't say it's kind of almost gone back to what it would have been 6 months before the election, I'd say, where people had the confidence. And that's been the biggest driver. So it's kind of just gone back to normal. It kind of spiked up. Probably a couple of months after that, we're seeing an increase. And now it's kind of dwindling down a bit. And that's also seasonal as well. We're getting to the end of the buying season. And like I said, it is really funny that even refinancing with home loans seems to have a seasonal trend, and it's just, I think it's that frame of mind when people are thinking about their finances. This time of year, people start to think about what they're going to do for Christmas, and where they're going to have Christmas lunch and what they need to serve for, and getting the presents together. They're not thinking refinancing, getting documents together. Sure. So yeah, that's definitely. That's essentially been my take on it.
Okay, very very interesting. So bit of a peak after the election, and then now easing down as you'd expect towards the end of the year. Now, what about the mix of deals? So if I think of investors versus owner-occupied prospective purchases first, what were you seeing on that?
Yeah, there's definitely I'd say definitely more owner-occupiers. I'm not seeing any spike, or probably I'm seeing more of a I'm seeing a lot lesser investment deals and loans coming through. So yeah, that's what we're sort of noticing. It's not a yeah.
Okay, so owner occupiers, and then if you think of owner occupiers, some of them will be first time buyers, some of them will be refinancing and perhaps trading up. So what about the mix of deals within that owner occupied area?
Yeah, so with that owner-occupier area, after the rate cuts, we've seen a huge increase in refinances, and I think that's obvious.
Yep.
It always jolts people to want to go out and, get a better deal, and that's quite common. For first home buyers, I think a lot of people at the moment are actually holding off for the first home buyers scheme. So there's been a bit of a halt that we sort of felt in first home buyers because people are kind of just waiting for it to come out. And for a lot of people, it makes sense. And this is, I think we touched on before with, the younger generation find it so hard to get that deposit together. And that's why people are holding for that as well. So that's what we felt.
Okay.
I mean, I'll just say on the purchasing side of things as well. So this is where I think it gets a bit interesting with what you hear in the media and then what sort of actually is happening on the front line. So one of my good friends does a lot of the marketing. They're a really big marketing agency. They do the marketing for all these big real estate firms a lot of us know. And when I talk to him, he talks about it like it's a bloodbath. They're in absolute shock. So they make their money on the number of listings. So he's been a really good resource for me. When I call him up and say, how are things on your end? And he told me way back, he said, things aren't looking good. And that was just before we had the big crash. Well, not the big crash, but the big decline in property prices. He was giving me a good sense of that way before it. And that's what I feel as well with new purchasing. We're not seeing anything, but then you hear in the media, house prices going through the roof again. And I think that's a classic of, not enough supply on the market. And it's not actually a true representation of what the value really is, I think. I think there's people that are always keen to move into their own home. And if there's a small stock, you're always going to drive it up. But I don't think it's really a good indication of the overall picture of the market.
Now, I think you make a very good point about the volumes. We know that the listings volumes are well down, and we know that the transaction volumes are well down. The stamp duty data from New South Wales that came out recently was still nearly 20 to 30% lower compared with a year ago in terms of the throughput. So that's another indicator, even at the end of the process. But one of the things I'm interested in is the underwriting standards of the banks now compared with, let's say, 6 months ago. Because, of course, APRA basically released the taps. The banks basically dropped their rates as far as they could, but they're still quite tight on their underwriting standards. So what's the overall impact in terms of the lending standards compared with, let's say, 6 months or a year ago?
So it's because I think there was that recent asset case that you mentioned that basically made a lot of the banks realize that they might have been over stringent with their criteria. And a lot of that was, getting real detailed with looking at people's bank statements and their expenses. So I think the biggest change hasn't been all of that. It's been that when a lot of these stricter criteria was brought in, they didn't have the capacity to keep up. So they've made the loan process, say have twice the admin work when they've got the same amount of staff and the same old processes. So it's taken them a long time to realize to fulfill the extra admin roles that they might need to actually go through that and be able to process a loan efficiently. So that's like at the end of the day, a lot of the answers are being coming back the same. The same people that would have got approved are still getting approved. Their borrowing capacity might be a little bit less, but it's just taking longer. And I think a lot of that's catching up. And that's the kind of frustrating part. They're still saying yes. They're just taking, a lot of them were just taking forever to actually say it. And they come back with those, I'm sure you've heard of it. They'll come back and say, you've put down, $50 a week for Foxtel, but we've got here on your bank statement, it's 65, so what? But that's the things that they're picking up on, and they're clarifying it. And then if there's a delay, it takes it could be a 3-day turnaround, or it could even be a week if they're super busy to even pick up your response, review it, and then they might catch something else. So yeah, I think it's the process is just getting a lot better, and people have an understanding of what that responsible lending actually is and what it looks like. And I think it's still going to be a few months. I think the the stuff that you mentioned with APRA helps with the borrowing capacity. I think, I think it's still going to be a few months before it comes into effect. The biggest thing is that responsible lending and expenses. So that's the clarification that they need to come to agreement on what is reasonable around that.
Sure, and we know that ASIC are going to come out sometime quite soon now with some revised guidelines. And we also heard today that the court case between ASIC and Westpac regarding HEM is going to go back to court, for basically another hearing back in February next year. So that's going to be, I think, another critical landmark too. But clearly there are still some uncertainties about some of those underwriting standards and expectations. Now ASIC has been saying quite clearly that they are of the view that a benchmarked approach to expenses is insufficient. So whether it'll be clearer after their latest guidelines, whenever that comes out, will be interesting to see, I guess.
Yeah, definitely. I think with the benchmarks, the HEM that they were using, I think in theory it could work. It was just that it was way under reality. So a benchmark can work quite efficiently. It's just that it was grossly underestimated what people are actually spending in a month. That's why. Yeah.
And of course they lifted them, right? So about July time this year, most of the lenders lifted those floors. So in fact, they're still applying a HEM, but on a bigger number. So that's, I guess, part of the story. What about the mix between business written to the banks versus the non-banks? Because certainly last year, it seemed to me from the data that the non-banks were stealing share from the banks. Is that still happening, do you think?
Yeah, absolutely. So I'm not sure if you so when we first launched our site, our whole thing is that we represent loans cheapest through the most expensive. And we got some major brands on there. And I was really curious out of my, understanding of what people, what people end up going with and what would they would actually pick themselves. So I thought that the brands and the banks would be a really big thing. So when we actually launched we kind of launched it as you can it's trying to give you the same answers a broker would essentially should give you. And it's I'd say 99 out of 100 when I ask them the question, and mind you, I don't actually do too many loans these days. I'm more on the marketing side of things of the business in operations. But when I was asking people, do you want the bank that's going to get you the money that you're after with the features you want at the lowest rate, or is there a particular one of the big four that you want? 99 out of 100 said, I want the cheapest one. And I think it's really becoming to that point where if you present someone, hey, here's option A, here's option B, here's option C, they're all going to give you the money with these features. A lot of people are moving to that online space. And I think it's that one thing is a little bit hard for me because we get people who are online and they're savvy within that space. So for them, they understand the whole online thing. So for them, if it's got an online bank account, I'm going for the cheapest one. And it was a good test for us to test that theory out on how loyal people were to the brands of the big banks. Yep. And there's been a big shift, and I think the Royal Commission hasn't helped at all. To give you some examples, we would have people call up and basically say anyone but the effing big banks, and it's all stuff from that they've seen on that they've just sat there and watched the Royal Commission, and they said I can't give these guys money anymore. So they're starting to look at other options, and a lot of these non-bank lenders too. Their underwriting could be from a major bank. So when they get into the nuts and bolts of it, we've got someone in our panel. And the underwriting offers really good rates, and the underwriting is done by Adelaide and Bendigo Bank. So if a customer has any concerns about that lender themselves, you go, well, the money's actually coming from the 5th largest bank in Australia, but you're getting this much better rate. There's a lot of that happening in that space. So there's a huge shift away from the major banks, and I don't understand their strategy either. The one edge that they had was they had branches, and then they're closing the branches down, but they still keep the same interest rates. The idea is if you're going to push online, you need to be more competitive. It's like anything that we've ever experienced in our modern lives, that once things go online, normally the price gets reduced. You don't keep it the same. I've definitely felt that.
Very interesting, because my surveys, one of the questions I ask is those those brand drivers. What's really important to you? Is it price? Is it brand? Is it flexibility or something, right? And it's really interesting that across all of our household segments, even those who are not digitally enabled, price is by far the most critical element. Not surprisingly, because of course, the interest rate's so critical in terms of how much you have to repay. But what is also surprising is that the brand association that 4 or 5 years ago had very strong resonance around the big four and the regionals has completely gone away. People just really have said, well, it makes no difference to me whether it's X, Y, or Z brand. If it's got the features, if it's got the price, it's got the flexibility that I need, I'll go for it. So ultimately, the industry is more and more and more fighting on price and accessibility. And that means that the online channels are going to win out every time because they're just so much more accessible.
Well, that's the bet I'm having, Martin. So that's been my philosophy from the start, especially that's why I started Hero Broker. I thought it might not be there yet with people being online, but it's definitely where people are going, and that's what people expect. And I think when we launched our online application, there was only 4 people in Australia that were doing it, and Commonwealth Bank weren't even doing it. So there was maybe us, I think Uno, I don't even think Lendy had done it yet, and then there was maybe one other lender or something. So yeah, it's acquisition. It's just making that easy use, and that's where open banking comes into it as well. Making it super easy for people to switch, get the better deals. It's all changing. It's a completely different game. Banking is what it used to be.
Absolutely, and I guess one of the key points to say is that if you are sitting on a loan that you've had for some little time, particularly with some of the major organisations, the chances are that by shopping around you could probably do quite a lot better, unless you're one of those that are in negative equity or a very high loan to value ratio. But if you've got a meat and potato loan, the chances are there's a better rate somewhere.
Oh yeah, definitely. That is the striking thing that I think it's still changing. I think there's a recent survey that came out that 60% of people don't understand what interest rate they're paying.
Yep.
And I've got a mate who's a classic example of that. Someone that you consider smart, intelligent. He's a physiotherapist. He, runs his own business that's quite successful, and he's known within our group of mates as being, the one that's quite tight with money. And then I ask him about what he's doing with his home loan, and he's like, "Oh, I'm just with the bank that I started with, which is of course everyone knows the Dolomite account." I said, "Why'd you go with them?" I said, "Oh, I just thought it was easy. Walked in, got the loan." And he's paying way much more than what he should be. And so like people, when it's presented to them in the right way, absolutely people get it. I think there's still a bit of people are just a bit lazy with it. Like 60% of people don't know what interest rate they're paying. So yeah, there's some change that's happening there. But I think that the biggest change that's going to make that accelerate is just it being easy. If it's an easy process, the easier it is, the more people will be willing to switch. So when it gets like super easy, I think it's still going to be a few years away, but yeah, it's coming.
Well, one of the things I'm watching is this digital migration, and I'm fascinated by the fact that more and more people, households, are using the digital channels more for the search aspect of finding a property and finding a loan. And of course, as the digital processing catches up, more and more can be done online. So it's clear that the future is going to be digital online. And it's just a matter of time and how quickly that happens. But you're right also that people will be expecting to see a benefit in terms of the pricing of the product as a result of it. And at the moment, some of the big players out there actually don't give you any benefit for using the online channels.
No, they don't. And a lot of their interest rates, that's why they use the broker channel. They use them to push their unadvertised rates.
Yep. And
that's even why hashing really got to start, because there's all these which is another like a broker comparison site, because they'll push a channel that they know that it might be a broker channel that does a lot of volume for it, and they'll push a deal just through that channel. That's some red hot interest rate. And actually the founder of Hashing, he said the reason he started it was he was working at the bank, and he was almost bragging to one of his mates about, I've got this special interest rate because I work at the bank. He was working at one of the big fours, and his mate laughed at him and said, I've got a better interest rate than you from the same bank, because he got it through some unadvertised reduced rate through some broker. And he goes, how does, there goes my loyalty. And it's funny, we actually get a lot of people refinancing who are employees of the big banks, and because they can get better deals elsewhere. So they don't even take care of their own employees. But I've actually got something, I might share it to you, which gives a good breakdown of what you just mentioned about people doing their search online, because I had a catch up with like a marketer or someone from Google, and they gave us a full breakdown of that customer journey. And people predominantly start online. They do pretty much all their research. I think it's like 90% or something, do all their research online. They do all their rate comparison, and then they still at the moment, there's a large chunk that go offline to actually fulfill it in the end. But yeah, I'll share with you after the podcast. You might there might be some nuggets of gold in there.
Well, it's interesting because I do a lot of surveying of households and their digital experience, right? And I separate them between what I call the digital natives, so they're always digitally enabled and just want to do everything digital. The other end, you've got the digital Luddites, so they're the people who really don't want to touch digital, but that group is shrinking quickly. And then you've got this group in the middle who are the migrants, the digital migrants. And those people are more and more comfortable with the online journey and with the latest smartphones and all the other tools. So it's inevitable that the digital sort of footprint of people are going to get to ever greater. And then it becomes a challenge to the banks and I guess other people across the mortgage value chain to be able to actually put in place the appropriate systems and processes to be able to meet the needs, because my reading of households is that they are demanding a lot more than many of the providers can actually offer at the moment.
Yeah, it definitely. And that is another thing too, when people are quite demanding of their apps and their websites these days as well. They're very demanding of what it should look like, feel like, how efficient it should be. So yeah, and that's like any industry. At the end of the day, it's driven by consumers, isn't it? So if you want to compete and get the customer, then you got to essentially give them what they need and what they're after. And yeah, like it is funny, like you said, there's that gap of people in between. We find that there's a lot of people that don't fit the stereotypical demographic that you'd think are quite tech savvy and want to do things online. And there's a lot of like boomers and Gen Xers and stuff who are, you might build a product and you think it's for the millennials, and then it's 40 plus that are using it, and that's quite common as well.
Yep.
Yeah.
No, I agree with you. And the old idea that it was the very young people who were digital and everybody else wouldn't be is completely thrown out the window now, according to my data. In fact, Definitely. some of the more savvy users are the time poor, slightly more affluent people who are just on their devices all the time and just expect to have the home loan processes as part of the journey, right? Whereas in fact some of the younger people are a little bit less willing and able. So yeah, I agree that the age thing isn't necessarily a good measure. Now, talking about these segments, you made an interesting comment to me as we were setting up for this, that the Gen Ys, you think Gen Ys are really important ahead. Can we just explore that a little bit?
Yeah, so I've got a bit of a theory around the Gen Y and sort of the housing market, because I think, and that's what I wanted to talk to you as well about, the current policies, and because I actually believe I'm on board with you with a lot of the things that you say around. There's big debt cycles that happen in generations and everything else, and I think we're sitting on a pretty big amount of debt. So there's certain things that you need to keep this debt bubble going. And the one thing this is my prediction before the crash. At least I can say I predicted the crash the very last month that prices were still going up, and then every month after it's gone down until recently. And at that time I predicted a couple of years we're going to have some tough times. There has been a lot of policy changes that I think feel like it's propped up the market somewhat. I think there's still going to be a trough, but then I do see that the demographic of Gen Y, we're starting to make up the largest demographic in the workplace now, and starting to mature in the workplace and earn decent money. So I think there's surveys on the younger generation saying home ownership, they feel like it's not something they chase anymore because they feel like it's out of reach. But I feel that's what people say when they don't have enough money to afford a house. I feel like once someone starts to earn a decent amount of money, they have a girl that they want to settle down with, and they want to have a couple of kids, the they start thinking about a house, whether you like it or not. And I think there's that big maturity of this age group. I think the reason they haven't shot up as fast as the boomers is because the boomers are still working when traditionally you would retire at 55. They're working on because people are living older and healthier now. So I think a lot of these bigger, more senior positions we still haven't, that Gen Y still hasn't really matured into that higher income bracket. But in saying that, so I feel like there's going to be this huge wave of people who have been living at home with mum and dad, have been struggling with a career. Then they're going to start hitting a strap, start earning good money. And I don't think they want to keep living at home with mum and dad. I think they want to get out there and buy a house. And I just don't think, I think that's still a few years off. But what I do notice, if I was to look at, you might have some data on this as well to back it up or dispute what I'm saying. But basically, if I look at people who are in what you call a young man's game, so trades and services, I see my mates actually, you'd still consider young, but out there running their own business. You know, they're either supervisors. I've got mates who work in the mine sites over in Western Australia. They're supervisors or superintendents. And that's because the older generation don't hang around in those jobs because it's a very physical, hard job. So I see them out there earning good money, running good businesses, because they've got that opportunity where they don't have a huge number of, more experienced people out competing for their work. So I just think that a lot of the professions that are out there, there's still a lot of jobs being held by people who haven't retired. So yeah, I just see that there's potential for this big demographic of people working, start earning good money, super keen to come in, build their families as well, because they're having kids later as well, settling down later. And it doesn't mean that they don't settle down or don't want to settle down and don't want to have kids. It's that they're just doing it later. And we haven't felt that yet. We haven't felt that surge of earning good money. I need to have a house. I want to have a house for my kids and everything else. So that's going to be, and they're notoriously bad savers and big spenders. So what's going to happen when they start to flood the market?
Yeah, well, it's interesting because I shared with you one of my charts, which is the Household Financial Comfort Index, right?
Here, actually.
Yeah, and what's interesting about that is that at the moment, it's the 20 to 30-year-olds and the 30 to 40-year-olds that are actually feeling the least comfortable with their finances, right? And that's a function of the fact that their incomes have not been growing at all relatively recently. The costs of living are rising, despite the fact that mortgage rates, if they've got a mortgage, are lower. And they're having difficulty saving because of the fact that, it's just costing a lot more to live. So the critical issue, if you're right on your analysis that there's a big bulge of potential, Gen Y who want to purchase, it'll only happen, I think, if we start to really see those income trends change, right? Because whilst I agree with you that there are a few sectors of the market where incomes are a little better simply because of, as you say, their particular segments, for most people, there's been no real income growth in real terms for at least 10 years. And I can't see at the moment with the current settings that we've got in Australia how that is going to change. So I think that for the property market to really begin to motor for that particular segment, we've got to expect incomes to rise. And the question is, one, how likely is it? And two, what would need to be done to make that happen? Because without it, I frankly can't see it's going to happen.
Yeah, I think it's going to be really hard to predict because it's the one thing I did pick up on your chart is there is that big gap in the middle.
Yep.
And I think that is the big gap where it's hard to break in the age groups to break it down where there's a huge acceleration in probably income that you're getting. That's where you really create.
Absolutely. Yeah. So just to be clear, the 30 to 40 year olds, are down near the bottom with the 20 to 30. The 40 to 50 year olds are quite a lot higher. They're actually above the average, right? So that's the wealth transition point. Well, traditionally it's been, right?
Yeah.
And so the question is, to what extent is that going to continue? And that's why I think this is really interesting. And that's why I think this segmentation, however you do it, is really important because you can't just group the whole market together and assume it all works the same way. It's not like that, right? And so there will potentially be pockets of prospective purchasers. A lot of them will be either in the market now or in the market for the first time, because many first-time buyers are buying later. But the other group that's really interesting is what I call the up traders. So these are people who've bought a property already, and maybe have bought it for a few years, and are now beginning to feel a little bit more wealthy because they are being promoted and therefore their incomes are rising. And those are potentially some of the ones who are still active in the market. So I'm seeing quite a few of those up traders still looking as though they would like to transact over the next 12 months to 2 years. And then the other group, surprisingly, is the down traders. So these are the older ones, because now they've got bigger properties that they don't want to keep anymore. So there's going to be an interesting trade-off between the people trading up and the people trading down. Problem I see is at the moment there are 3 times as many people wanting to trade down as those able to trade up, simply because of the economics of incomes and property costs. So that's going to be the really interesting, if you like, crunch point between how the market evolves, assuming that property investors still stay on the sidelines, because at the moment all of my surveys suggest that property investors are still really not that engaged with the market. So it's going to be a battle of the owner-occupiers, people trading up and people trading down.
Yeah, definitely. I think that is another thing that I've thought about quite a lot as well, is that there are the baby boomer or the older generation can just say that they have multiple investment properties because negative gearing has been around for so long. And what does happen when they eventually start passing away and they're sitting on 4 or 5 properties, and then it goes to their kids? Will they then sell the properties, and then we have an influx of properties on the market, and then that could potentially drive things down? Or will people most likely sit on them and just, do whatever? But we all know that families around that sort of stuff, it can get tricky, and selling is normally the best option for everyone. But with that, what you said about trying to see that younger generation and getting that increase in wealth and in their jobs, I think that's where it gets a bit messy and clunky, because it's the one thing about running a business, and I'm friends with a few other business owners, is everyone's always trying to look for talent. Trying to get talented people to come work for you is the number one hard thing. And at the end of the day, you have to just go with whoever you think is the most talented to run that job. And at the moment, I don't think we're really seeing what's going to happen when the baby boomers do retire, and you've got a smaller pool to choose from. And at the end of the day, you're going to have people that are going to start leapfrogging up into roles that are paying a lot more. There could be a lot more competition, because I think that's the other big thing that they're worried about, the boomers, is that if they don't keep working, there's actually going to be a big shortage of skill too. So I think with that pressure on wages, I don't think we've really felt that yet, and we might feel that in the future. That's where my headspace is at when I say those comments. I think that there could be a lot of people that, within a few years' experience, catapult their careers. And to give you a background on that too, the one place I've seen that happen massively was the mining boom in Western Australia. So I was over in Western Australia when the mining boom was happening, and I even worked out in the mines for a bit. And it was, they were so hungry for people. They'll take someone from a school teacher who's done a course and catapult them into something that would normally take 4 years experience to do. So when those environments do get created, people do, at the end of the day, businesses need to make money and they need people to do it. So it's hard. It's because you're starting to predict the future and there's so many variables in it. But that's where my head's at with all that sort of stuff.
No, very interesting. Well, I think we can probably both agree then that there are a lot of cross currents in the property market at the moment, a lot of unknowns, and perhaps some of the very strong headlines about the property market is fully recovering and now's the time to buy is probably a little bit too over optimistic based on what you're seeing through your channels, what I'm seeing through my surveys. And the truth is, there may be a few hot spots, but actually I think for the next 2 or 3, maybe 5 years, I think the property market's going to be quite bumpy.
I think you're pretty correct on that. A lot of people think that I should be a bit shocked when I'm not spruiking the market and saying you should go out there and buy, because at the end of the day, I never want to give advice whether you should buy or not. It's your decision. I'm here. I focus on, if you are after finance, I'll try to get you the best deal. But I have my own beliefs, which is similar to yourself. And what is crazy is because I have a bit of an interest in how the economy works and the debt cycles and everything else, and because I'm into history, so you start studying the Great Depression and the booms and busts that we've had. It all kind of repeats itself, and what we're experiencing here is being experienced all around the world. But what I find is interesting is you understand the stats. You understand the stats way more than me. I have somewhat of an understanding and appreciation of the stats, things that you should look for. But I know a lot of people who have 6, 7, 8 properties, property developers, business owners who don't even think, they just go off what their friends tell them. They don't actually don't have any understanding of debt cycles, what it means. Like, even ask the question, why is the economy going so good? What's driving it? If I am going to buy 2 or 3 houses, what am I backing that on? And it's funny, people's reasoning for buying houses, and a lot of it doesn't go back to the stuff that we're talking about.
No, absolutely. There is a bit of a herd mentality. There is a little bit of talking around the barbecue, and of course the old assumption that property prices double every 7 years is still out there. I can tell you, it's one of the things that I detect in my service, despite the fact that reality is nothing like that.
Yeah, and it hasn't. People have been saying it for the last 30 years. It hasn't crashed yet. So that's the one I keep hearing. People go, I keep hearing about the crash. They've been saying it for 30 years. It's not going to happen. And I say, it's not representation of what's going to happen now. But yeah, sometimes you just come across as a doomsdayer. I'm sure you more than anyone have experienced that.
Just a bit.
Yeah.
And I try to keep a bit of balance, but I have to also look at the data. I have to look at the cycles in history in the past, and I have to look at that debt. We keep coming back to it. The debt in Australia is higher than almost anywhere around the world. 191 debt to income ratio. That is astronomically high. We're the second highest on debt to GDP relative to almost everybody else. Switzerland's a bit higher. Those are excruciatingly difficult numbers, and what that means is that we can't expect this debt cycle to continue forever. And therefore, maybe property that has been for a generation or two, the one that goes on giving and giving, may not give quite so far and fast ahead. And so it's worth just tempering all that enthusiasm and exuberance that we're seeing in the mainstream media with a bit of reality sometimes. So I really appreciate your time today and a chance to explore the industry from your perspective. So thank you for that. And we'll put some links and things below so that people can find you post this particular show, and maybe we can pick up the conversation again in the new year and see how things are progressing then.
Sounds good. Thanks, Martin.
Good to talk to you. Thanks very much. Cheers.
Bye.